Welcome to this explainer. Today, we're diving straight into something absolutely fascinating. We're going to demystify one of the most secretive, complex, and, let's face it, trillion-dollar ecosystems on the planet, the world of hedge funds. We are going to look at exactly how they operate, how they evolved over time, and really unpack this hidden architecture of risk and power that heavily influences our modern global economy.
Okay, let's dive into this. Before hedge funds became these towering symbols of extreme wealth and power, the whole industry started with an incredibly simple yet profound realization by a man named Alfred Winslow Jones. His foundational philosophy was just this: uncertainty cannot be eliminated, it can only be managed.
Section 1. The first hedge fund. Now, here's the crazy part. Alfred Winslow Jones, he wasn't some hotshot Wall Street banker. He was actually a sociologist and a journalist. Looking at the American financial system in the late 1940s, he saw a society that was still deeply traumatized by the 1929 stock market crash. That was a time when entire fortunes and families were wiped out almost overnight. Jones believed traditional investing trapped everyday people between two incredibly raw human emotions: greed when markets go up, and absolute paralyzing fear when they crash. He desperately wanted to find a way to balance those emotions.
So his solution was a concept known as hedging. Think of a hedge as basically building a barrier around your risk. For centuries, farmers actually used this principle with commodity contracts to protect themselves against sudden price drops, and airlines would later use it to lock in fuel costs. Jones simply adapted this logic to the stock market. He figured, hey, instead of only buying companies I hope will succeed, what if I also short or bet against companies I think are going to fail? By doing this, the gains from his good investments could offset the losses if the overall market tanked. Originally, this wasn't about reckless gambling at all. It was literally all about protection.
Section 2. Two parallel financial worlds.
To see how a well-intentioned idea turned into the massive, invisible architecture we have today, we kind of have to rewind. The timeline of modern Western finance was truly born from catastrophe. During the Roaring '20s, markets boomed. Speculation was everywhere, and regular folks bought stocks on borrowed money, assuming the market would just rise forever. But then, 1929 hit. The market completely collapsed, ushering in the Great Depression. In response, the US government brought the hammer down in the 1930s, creating strict regulations and establishing the SEC to enforce transparency. Now, this made public markets much safer for everyday investors, but it also created some very strict, rigid rules.
Well, highly sophisticated, super wealthy investors found these new rules way too restrictive. They wanted their flexibility back. So, regulators allowed a legal carve-out for what became known as the accredited investor. The law basically assumed that if you had a massively high income or significant net worth, you were financially savvy enough to tolerate big losses without needing the government to hold your hand. And this brilliantly illustrates the stark contrast that emerged. This one legal distinction effectively split our economy into two parallel financial realities. On one side, you've got public finance. It's transparent, heavily regulated, highly accessible, and standardized. On the flip side, you have private finance, highly secretive, incredibly flexible, completely exclusive, and wildly experimental. Hedge funds quickly became the defining institution of this second hidden world.
Section 3. Mechanisms of risk.
So how does this private experimental world actually operate? Well, unlike a standard mutual fund that just buys stocks and waits for them to slowly go up, hedge funds will use almost any strategy out there to generate a return. We're talking speculating on global interest rates, trading distressed debt, and buying exotic assets ordinary people have never even heard of. But their most powerful tool, and without a doubt their biggest risk, is aggressive leverage. That means they use massive amounts of borrowed money to amplify their positions. It's like strapping a rocket to your portfolio. It creates the potential for astronomical profits, but also catastrophic total collapse. You want to see this double-edged sword in action? Look no further than the spectacular failure of long-term capital management, or LTCM, in the 1990s. This fund was literally founded by Nobel Prize-winning elite economists who built complex mathematical models to exploit tiny market inefficiencies using massive leverage. Honestly, they seemed invincible until 1998, when the Russian financial crisis hit unexpectedly. Their models completely failed, their positions collapsed all at once, and because they had borrowed so much money from major banks, their failure threatened the entire global financial system. The Federal Reserve actually had to step in and coordinate a rescue just to prevent a worldwide economic panic. It was a stark reminder that these private funds could threaten global stability. And we've seen this dual nature of hedge funds play out repeatedly. Think about the 2008 global financial crisis. Some funds entirely collapsed, while others, like Michael Burry's legendary Big Short, made absolute fortunes by betting against the fragile housing market. Then, fast forward to 2021 with the whole GameStop phenomenon, where everyday retail investors banded together online to directly challenge large hedge funds. Both of these events really highlight how hedge funds can identify systemic weaknesses before anyone else, but they also serve as a major lightning rod for broader public tensions inside modern capitalism.
Section 4. The Information War.
Welcome to the modern era, where giant firms like Citadel, Bridgewater, and Renaissance view finance as straight-up technological warfare. Look at the sheer scale of what's happening now. These funds aren't just hiring standard business majors anymore. They were recruiting top-tier physicists, mathematicians, and AI specialists. They engage in high-frequency trading, where success is literally measured in microseconds. They will actually spend millions of dollars just to physically move their data centers closer to the stock exchange, simply to reduce transmission delays by a fraction of a second. Because in this world, that microscopic informational advantage can mean billions in profit.
So the crucial point is the staggering difference in the data being used. While an everyday retail investor is sitting there relying on normal broker jobs, public filings, and historical data, modern quantitative hedge funds are feeding off a diet of proprietary AI algorithms, real-time satellite imagery of global shipping patterns, and elite private political intelligence networks. It is a fundamentally different game played on a totally different playing field.
And playing this game, it is incredibly expensive. Which brings us to their infamous compensation model, widely known as 2 and 20. Historically, hedge fund managers charge a 2% annual management fee on the total money they manage, plus 20% of any actual profits they generate. To put that into perspective, if you run a billion-dollar fund, that 2% fixed fee alone generates $20 million a year, just for keeping the lights on. And they get that regardless of whether the fund performs well or has a completely mediocre year. It's kind of mind-blowing, right?
Section 5. Buying power and access.
Now, you might be wondering about something. Studies over the last 2 decades have consistently shown that numerous hedge funds actually underperform simple, low-cost index funds once you factor in those massive fees. So if a basic index fund often delivers better long-term results, why on earth do the ultra-wealthy and massive institutions keep pouring trillions of dollars into hedge funds?
Well, here is the ultimate twist of this explainer. The truth is, these investors aren't just buying financial returns. They are buying access. They are securing entry into private, strategic deals that are totally unavailable to the public. They're joining elite networks that act as private clubs for global capital. They get early intelligence on intersecting political and technological developments way before they hit the mainstream. And let's be real, within elite circles, investing in a top-tier hedge fund is an undeniable signal of extreme social status and immense influence.
Because of this very dynamic, hedge funds have transformed into massive centers of geopolitical influence. In major global hubs like New York, London, Toronto, and Geneva, the worlds of finance, politics, philanthropy, technology, and media are increasingly overlapping. The decisions made by a handful of hedge fund managers today can literally impact global energy prices, shape corporate governance, and even affect national economic stability. They aren't just trading stocks, they are navigating uncertainty on a global scale.
Which leaves us with this final, really profound question to consider. As finance becomes less human and more computational, relying heavily on AI and alternative data, this hidden architecture we've explored today is only going to grow stronger. So, does this massive concentration of extreme financial intelligence and power deepen societal inequality, creating a permanently rigged system? Or does it simply reflect the fierce, competitive logic of advanced capitalism doing exactly what it was designed to do? I'll leave you to ponder that. Thank you for joining me for this explainer, and remember to always keep questioning the systems working behind the scenes.